I do have to talk about the new accounting standards, revenue and leases, but you'll be pleased to know I do have a couple of other things that I can talk about, not just revenue and leases. So we're going to start off by looking at some new disclosures that not-for-profits have to put in, and I'll tell you why we did those disclosures, and hopefully you will agree that they're not onerous, and that's why we've given a really short implementation date. Generally, we would give you 2 years to implement a new standard. We gave you about 6 months in this one, but we really don't think it's a big issue, hopefully. Then we're going to look at the definition of a not-for-profit. We have got a project that we are looking at that, changing the definition of a not-for-profit. Now, you all work in the not-for-profit space and probably know that depending on which legislation you pick up, there's a different definition anyway. So what deal does this make? The reason that we're doing that is because our standards are quite different in many cases for not-for-profits and for-profits. We have specific paragraphs. We are looking to change the framework and give a different framework for not-for-profits that will be very different from a reporting concept element to a for-profit, and that's why we have to get the right people reporting. My view is if you met the definition in the past, you probably aren't going to change. And we think there's a couple of entities that may, but we should still be where we are. So we'll talk about that, and then we'll have a look at the changes to the financial reporting framework. At the moment, our focus is on for-profits, and that's because we think there are a lot of for-profits reporting in a way that possibly isn't appropriate. So we're really looking to push the changes through to them. What I want to talk about today is what changes are going to impact you, and there will be some of you in the room that are impacted much quicker than others. And then I will look at where we're looking at being on the board going forward. Then we'll do revenue and leases. So let's start with the new disclosures. These disclosures, as I say, kick in from 30 June 2020. And to give you a bit of background behind them, we're obviously doing this project that looks at special purpose, general purpose. And to say we're the only entity, yeah, you can take photographs. You can also, I think we'll send a copy of the slides. We'll send you copies of the slides afterwards. We're also the only country in the world that allows lodging entities to lodge this thing called special purpose financial statements, which means that an entity can effectively pick and choose which accounting standards they comply with. Seen as a little bit of a laughing stock internationally for doing that. So we've been working on this project for a fair while, and we're really getting some great traction on it. As part of doing that, one of the things that we had some academics doing and some fairly senior staff at the IISB doing was reading financial statements. We firstly ran a load of financial statements through some sort of computer system, and to say which are general purpose, which are special purpose. And those which are special purpose, could we tell which standards they complied with? Could we tell whether they complied with recognition and measurement? And the results were quite scary, and the computer couldn't tell. Now, they were looking for words like, we've complied with our recognition and measurement. So we then got the staff to actually sit and read them. They still couldn't tell. In many cases, there was about 15% of financial statements that they read that they could not tell what had been complied with. Now, how is that useful to users? It isn't. So we said, okay, we're going along with this project, but as an interim measure, we need to have some more transparency in the financial statements. So we've introduced these disclosure requirements for only not-for-profits at this point in time, because we are forcing other requirements onto the for-profit, so therefore it was only going to be relevant for a year for them. So what we've said is if you are required to comply with 1054, so 1054 is our additional Australian requirement standard. If you are a lodging entity with ACNC, generally with any state regulator, you are required to comply with 1054. So if you're required to comply with that standard, we want you to tell us what you do. We don't want you to change anything, we just want you to tell us what you do. So in relation to recognition and measurement, have a think. Do you comply with all recognition and measurement? And if you do, fantastic, just tell us that. We comply with all recognition and measurement requirements within the standard. If you know that you comply with all recognition and measurement except for example, we don't comply with recognition and measurement because we recognise general bad debt provisions. Tell us that. That's it. If you've got absolutely no idea whether you do or you don't, tell us that. We have not assessed compliance with recognition and measurement. So we don't want you to change anything, we just want you to tell us what you do. So then users of your accounts can actually read it and say, okay, it is accounting standards, it is apart from, or all you've done is prepare financial statements in accordance with the accounting policies that you've disclosed. So hopefully that's not too onerous, because it's purely just a statement on what you have done. The other element of it is in relation to consolidation and equity accounting. What we want you to do here is, if you know you have subsidiaries, joint ventures and associates, have you accounted for them properly? Have you fully consolidated? Have you equity accounted? And if you have, tell us that. We've fully consolidated all of our subsidiaries, we've equity accounted completely for all of our associates. If you haven't, tell us why. We haven't done it because there's no requirement in the ACNC Act. We haven't done it because we actually can't get the information from them. We haven't done it because they're a for-profit and we're not. Whatever reason you haven't done it for, they're not material, whatever it is, just tell us. If you haven't determined whether you've got subsidiaries, associates or joint ventures, just tell us that. Now the reason we put that in is because under the ACNC Act, I might take this necklace off because that's what's clanking away at you. If under the ACNC Act, the charity is, or the registered charity is the main entity, there is actually no requirement under the ACNC Act for you to consolidate, do joint venture accounting or equity accounting. And we know that. That's why we've actually put this in. It looks a bit weird. How do you not know if you've got a subsidiary, a JV or associate? But when we wrote this standard, we were very conscious that we did not want to give huge costs to a not-for-profit to comply with this disclosure. Within this standard that's been issued, it's 2009-4, the standard is about 25 pages long, which is a bit ridiculous when all it tells you to do is exactly what I've just told you to do. However, what we've got in there is more examples than you can shake a stick at about what your disclosures should look like. So go to the back of that standard, have a look at the examples, look and see which bit you fit in, and we've given you some kind of template words to look at. So that's the disclosure that will be required for special purpose, not-for-profit financial statements at 30 June 2020. Any questions or comments? Now, hopefully, as I say, it's not too onerous, because we're just asking you to tell us what you currently do and what you currently know, and if you don't know it, tell us that. There is no penalty for doing that, because if you say you don't know, you're not in breach of anything at this point in time at all. In regards to the new definition of not-for-profit, an exposure draft has been issued, and we are considering comments. Our next board meeting is at the beginning of March. Haven't yet seen the agenda of that. I'm not sure if it's on there, but the staff is certainly analysing comments. This is our proposed definition of what a not-for-profit will be. Our old definition is an entity whose principal objective is not the generation of profit. This definition is the New Zealand definition of a public benefit entity. So where we can copy things that we think are quite cool, we will often do that. New Zealand, we're kind of looking at their framework and looking to see, can we align them at all? And we looked at that definition when it's probably better than ours. Definition is an entity whose principal objective is not generation of profit. It's a bit generic, and a bit kind of people go, where does that fit? Whereas this, at least we're talking about what's your purpose, what's your objective. As I said, we don't believe that there is that many entities in the real not-for-profit space that would be flipped out of that definition. And so we don't think it's too big an issue. If you are reading it and go, my goodness, for whatever reason, we will not satisfy that definition, absolutely, speak to me, let your HLB guys know, because if we can have that information at the board, we can then start looking and tweaking some of the words and going, is that right? Do we really want these guys not to be captured when prima facie it looks like they should? We've given some indicators to assist in whether you are a not-for-profit entity, but again, kind of look at them and they seem to be fairly obvious. They seem to be fairly strong indicators that you are a not-for-profit, as opposed to you're an entity who just says your principal objective is not the generation of profit, but all of the operations that you do, all of the things that you're doing with your assets, etc., might indicate that you actually are. Any comments on that in respect to that change? Yeah.
You just mentioned that was from New Zealand PBI definition.
Yes.
Please have a little bit of a conversation happening. What is the difference between PBI and DGR1 here? And if you're a DGR1, do you automatically assume that you're a PBI?
Okay, so PBI, is that a tax thing rather than an accounting standard thing? Okay, I'm getting a nod from the front row.
Okay.
you obviously know more about New Zealand things than I do, but in our standards in New Zealand, they have, I'm sure it's public benefit entities, PBE, and they have a set of standards for them. I guess it's similar to what we have in Australia, in that we have DGR, and we have our definition of not-for-profit, which is completely different to what you have to do to be a DGR status. So unfortunately, accounting standards doesn't necessarily tie up. So for this definition, this would only be for our accounting standards. All the definitions in the ACNC would stay the same, all the definitions in the Tax Act would stay the same. Why don't we align it? I get it, but it would make more sense. But what would we align it with? Because there is not one definition of a not-for-profit in Australia. So this, if you're not-for-profit for this, would not automatically mean you were DGR here, and vice versa. If you're DGR, probably more likely to mean you meet this definition, but not necessarily automatically. So I can't help you, I'm afraid. Sorry. Yeah, it's probably a tax person.
It's for grant submissions. And
right.
Often they ask to have PBI.
Yeah.
But we're DGR1, and I'm assuming it's a package too, I know that. But we'll go ahead and do it because we're DGR1.
And DGR1's the better DGR than DGR2, isn't it?
Well, better, I don't know, but
the reason I say that is because I was involved with an organisation, and we shifted from one to the other because it would have been set up wrongly, and there was a lot of grants we actually couldn't apply for because we didn't have the better one. So I would make the same assumption as you that I'll be in that space. Yeah. So we've talked about changes that come in at 30 June 20. We've talked about potential changes to definition. I just want to spend a little bit of time talking about where we're looking on the financial reporting framework itself. This is the major project of the board. At our meeting in March, this is pretty much what is on our agenda for 2 days, from what I understand. The imminent change for not-for-profit entities is if you currently prepare reduced disclosure financials. So you are doing general purpose RDR accounts, which we know there are a number of not-for-profits who do that. And that's great, because you don't want to do full general purpose because there's a lot of stuff in there that you probably don't need. And special purpose, you probably aren't really in that space in many cases. So we know we've got a lot of not-for-profits who do RDR accounts. Our proposal that will be hopefully finalised in March is that RDR will not exist from 30 June 2021. And before everybody panics and goes, oh my goodness, what do you mean it's not going to exist? We are proposing another framework, an alternative framework. And the alternative framework, I believe, will make life easier for people. I have been talking to people on the comments that they've put in, and I think we're going to find that there's some differing views on what we've got. But if you are doing RDR, any literature that you read about our changes to framework talk about only for-profits. This will affect you because our proposal, as I say, is to remove RDR. So what we will have is we will continue to have 2 tiers. Tier 1 is our full interest, which is required by listed, required by banks, required by anyone else who chooses to do that. I wouldn't really, in any not-for-profit, be pushing you to do this because I think that you can make your financial statements more meaningful by concentrating on other things and knocking out some of the disclosures here that aren't necessarily relevant. Our tier 2 is proposed to be called SDR, Simplified Disclosure Requirement. The name's awful, but nobody can come up with a better name. So that's what we're looking at. That will replace RDR. Now, the big differences around this, and I've got some areas where disclosures will increase and disclosures will drop. It is still general purpose. It is still full recognition and measurement. It is still consolidation and equity accounting. It is most presentation requirements. There are some things that were taken out. For example, you will still not be required to do the third balance sheet. And there is an option potentially within this new standard to say that the statement of changes in equity, if all you've got is retained profit, so you've got that statement that starts off retained profit last year, profit for the year, retained, potentially we can get rid of that because what does it really add? You can get that information from elsewhere. I have heard some commentators, some of the feedback. I haven't read any of the comment letters, but people keep telling me what they've put in them. I have heard that people don't like that. They want the statement of changes in equity. 5 years, I don't think it adds anything with all we've got is retained profit. But so that's why we're saying more to presentation. The big difference in this proposal is that if you want to find the disclosures in RDR, you have to look through every single standard. And you have to look at all the disclosure requirements, and you have to say, okay, well, anything that's shaded we can ignore, but often we have shading that's halfway through sentences, certain bullet points aren't relevant and others are. This is every disclosure in one standard that you will need to do. One separate standalone standard, and that standard is based on IFRS for SMEs. Now, I imagine not one of you in the room has read IFRS for SMEs because you have no reason to. It is the most plain English standard that you will ever have written, because it has been written, it was written internationally. When we talk about SMEs, it's not mum and dad. It is level below the listed entity. And it really has been written in quite a plain English way. So what we've done now is we've said, okay, well, if IFRS for SME is an internationally recognised standard, and they believe this is all you need to disclose for a particular topic, well, why are we asking entities to disclose more? If the recognition and measurement is identical, let's just leave it with that. For some areas, the recognition and measurement isn't the same. And then we've had to look and say, do we think we need to put some more disclosures in there? If we take something like leases, IFRS for SMEs still requires operating and finance leases. So what we've said is, well, actually, our lease accounting from a disclosure perspective, we could use the same disclosures that IFRS for SMEs requires for finance leases. So that's what we've pulled in. So that's where our change is planning to be. I understand that there are some people who've commented to this who've said we do not like the fact that all disclosures are in a separate standard. We want them throughout. I do a fair number of disclosure checklists. I do a fair number of checking financials. Personally, I think it's so much better to have everything in one place. But they don't like the fact that you've got your recognition and measurement in one standard and your disclosures in another. So we'll see what happens. I don't know how many people have commented on that, but that's certainly our proposal. So you will still have a reduced disclosure framework. It will just not be the RDR that you are used to. If you want to keep going on RDR, go for your life. But we will not be producing RDR accounting standards for any new standard that we publish. So it's okay now, but as soon as we issue a new standard, you kind of go, okay, now what do we do? You might have to jump into SDR to get that requirement. Any questions on that overall element? So let's have a look at some of the differences. So this is where we've got less disclosure in SDR compared to RDR. The big ones from your perspective, revenue disclosures have dropped dramatically within the SDR framework. I don't know how many of you have actually looked at the disclosures that are required by AASB 15. They are significant. We've dropped them dramatically within this standard. We've also dropped the leasing disclosures. If you look at the RDR, we haven't actually knocked out that many disclosures, but we have here. Financial instrument disclosures, there's not much required by RDR, there's even less required in here because we're really getting you to focus on what's important. I've talked about the option of not providing statement of changes in equity. In relation to AASB 12, which is disclosure of interests in other entities, so that's your subsidiaries, your joint ventures, your associates, again, we've dropped that down. We've dropped down some of the requirements for business combinations. And in the income statement, we've dropped some things off. We have proposed, and it's probably not as relevant for you guys, to drop off the income tax rec because it's not required internationally. We've had a fair bit of feedback saying that's got to come back in, particularly because of the environment that we're in at the moment. So that's where there's a lot lower disclosures. There are some areas where there are more disclosures in our SDR than we would have required in RDR. However, if we have a look at this, the majority of you in the room are probably only impacted by one of them, two of them, let's say. Hedging, probably not required. Now, my view is if you are actually doing hedge accounting, I think you probably need to disclose a fair bit about it, because if you're in that space, it is something that we wouldn't expect. If you are a lessor, there is more disclosures than is required within RDR, but again, that's probably reasonable, because if you're in that nature of business, we want more information about variability and about how you've actually recorded your receivables. Business combinations, there is more description around why goodwill has arisen and tell us about it. Give us some information about why you didn't acquire any intangible assets. A maturity analysis for leases, that's kicked in because of the new leasing standard, because you're now recognising your liabilities on the balance sheet, so tell us when they expire. Defined benefit plans, you probably don't have them. If you do, it probably requires a bit more disclosure. So there is a bit more risk around that. And then general information about the entity. You will often do that anyway because you're describing what you do, you're describing your main funding sources. Audit fees is proposed to go back in again. The reason it was never in RDR is because it's not an international requirement. So when we did RDR, we actually knocked out all of the Australian specific requirements. Again, in the environment that we're in and the pressure that's been talked about, quality of audit, etc., and the commission investigation that's happening, we just think that audit fees is probably appropriate to go back in. That's not a hard disclosure. So hopefully you can see that SDR will actually make life much easier for you if you are on the RDR. Anyone in the room is currently doing that full Tier 1 general purpose account. I strongly encourage you to have a look at this when it's released. We should be releasing it, definitely releasing it before 30th of June, hopefully around about kind of April time. So look and consider moving to that. Questions at all on that? No? So that's if you're currently doing general purpose financial statements. Let's have a look at where we are potentially moving to with our framework for the not-for-profits. We're a little bit further behind with this than we are with the for-profits because we decided that given the nature of a for-profit, we need to get their framework right and we need to actually make sure we're giving enough attention to the not-for-profits. So we are having significant consultation with the ACNC. I think you've got Mel Yates coming here next week. We talk to him regularly. He often comes to our board meetings just to sit in and actually listen to some of the discussions around these. The staff talk to the ACNC regularly. We're also talking to all state and territory regulators. So we've kind of taken the lead on hopefully, fingers crossed, trying to get one set of thresholds Australia-wide for reporting for Australian entities, Australian charities. So for those of you who operate in a number of different state and territories, you'd be aware that every different state legislation requires something different. The ACNC are really trying to kind of work with them and getting you to lodge with them rather than the regulators. But if we can actually get one set of thresholds, I think it would be a great outcome. So what we're looking at is now 3 tiers within the financial reporting space for the not-for-profits. Tier 1 currently is revenue less than $250,000. And if you have revenue less than $250,000 at the moment, all you have to do is lodge an AIS with the ACNC. No financial report. The proposal is to have that at revenue at about $1 million. If you are below that threshold, the current thought process is, say this hasn't got out an exposure draft, but the current thought process is that we will write an accounting standard that is a cash accounting standard. Similar to what is in New Zealand, similar to what is in the UK. Generally, it's about a 15-page long accounting standard, and it requires cash accounting with just tell us your major commitments. If you are locked in to pay rent, tell us that because it's important for the user to know. If you've got a significant number of employees, you've got employee commitments, tell us that. So that's likely to be that bottom framework, and then say likely to be revenue at around about $1 million. So significant change from $250,000 up to $1 million. And that was a recommendation that also came out of the ACNC legislative review. Hasn't been considered by Parliament yet. I understand it's on the agenda for this year, but if we wrote it in a standard, we could actually accelerate it quicker than waiting for the Parliament. The top tier is likely to be full recognition and measurement with the Tier 2 disclosure requirements. So that's the SDR that I just talked about. What's that threshold going to be when I've just told you that that one is now where the current top one is? The figures that are being bandied around, and this is probably a bit more uncertain, is 5 to 10 million. So we've said we really want to raise that and just have the top level of charities reporting at the highest level. We've done a comparison to what ASIC requires for their trading entities, and we're kind of thinking this would probably be around 80%. This would probably be around 5%, and then this would be the remainder. And that's still more than what ASIC require their trading companies to do, but we think those numbers probably better reflect what the structure of the charities are. At the moment, about 75% of charities who lodge with the ACNC have got revenue less than $250,000. So we're really in this space where we deal with a lot of small entities. So then the issue is this one. which will be somewhere between 1 million and 5 or 10 million, depending on what that top threshold will be. And this is where we're really uncertain. We're not sure what we should do here. The differing views that are out there is some sort of modified accrual. And it could be the New Zealand tier 3. So New Zealand have, I think, 4 tiers for their not-for-profits, 3 tiers for their for-profits. So possibly we could pick that up. Possibly we could pick up interest for SME. So it will not be full recognition and measurement. It will be some sort of modified base. These will only ever be minimum. So if you are currently, you've got revenue of $3 million and you're doing tier 2, we're not going to force you to drop down and go to some sort of modified accrual. Can, if you want to, but if you're already doing that higher level, you can absolutely still stay there. So this, once we've got the for-profit sorted, which should be hopefully in the next few months, this is where really we're putting all of our attention to. So this is a real watch this space. The AASB are looking always to engage within the not-for-profit space with roundtables and things to get feedback. To go, what do you think? Where do you think we should sit with this? So have a think. If you have violent objections to anything, absolutely happy to hear it now. But where do you fit under this new framework, and do you think that is appropriate? Likely time frame, probably around about 2024, that I would say this would be effective. That's not definitive. As I say, we're not even at exposure draft, but that's certainly what we're thinking about on board. Any questions, comments, thoughts at all on that? No? All right, so let's move on to revenue and leases. The big issue is, when should revenue be recorded? Now, as Aidan said at the start, we did defer the effective date for revenue for not-for-profits. And hindsight is a wonderful thing. I think it's probably one of the best things that we did, because there was chaos when the for-profits adopted this standard. If we had tried to have the not-for-profits adopting at the same time, who knows what would have happened. So what we got to do, therefore, is learn the lessons from the for-profit. In many cases, I think the not-for-profit space has been a little bit more prepared, and partly because they knew a new standard was coming. And I think many not-for-profits believed that we were going to issue a standard that said that all grant revenue would be deferred. We were never going to issue that standard because there's no accounting principle behind it. But as soon as the standard came out, we had lots of not-for-profits going, we're going to early adopt this. Are you? You read it? So much more engagement around that. Do I think the not-for-profits are prepared and ready for this standard? Absolutely not. But I think they're probably more prepared than where the for-profits were. So what I want to talk through today is talk through the issues that we're seeing, a bit of a reminder of what the standard is. I'm not going to go through every step within the standard. I'm really just going to pull up the issues that I'm seeing. So please encourage you to ask questions as we go through around this, about things that don't make sense, about things that you're not sure about, questions that you might have. So first of all, let's look at the lessons from the for-profit experience. Entities were not necessarily doing it right in the past. And that was a really interesting thing that a lot of the for-profits didn't like to see, but it was true. You often find that people just keep doing things exactly the same way, because that's the way we've always done it. And when you come to a new job, you don't go, okay, well, let's go back to basics and see if we're doing this right. You go, okay, that's the way you've always done it, we'll pick it up and continue going with it. However, when we say to you, you've got to look at all of your revenue contracts, all of your agreements, that's when you start realizing that possibly things went right in the past. So we had a number of entities who actually had to shift their accounting, not because of the new standard necessarily, but because they were doing it wrong in the past. Now, in the not-for-profit space, that's going to be really interesting as well, because we know that there are huge inconsistencies about what the accounting under 1004 is. 1004, in the vast majority of cases, requires all grant revenue to be recognised on day one, on receipt. How many of the entities do that? Not all of them, because they go, we know what we're incurring expenses last year, we got the money on the 28th of June, we're going to defer it. That is not allowed by the standard. Now, are those entities receiving qualification? Not necessarily. But what we're finding is when not-for-profits are looking at this and we're saying this is the accounting treatment, no, I can't believe we changed that. That's so bad, we used to be able to defer it. You didn't. You did defer it, but you didn't used to be able to. It was actually non-compliant with the standard. So we believe under the standards that we have given you the ability to defer more revenue, to do more matching, even though we say matching doesn't exist, but it will certainly not allow you to do all deferrals. So we'll talk about some of those a little bit later on. Sometimes the right answer genuinely is depends. And that's really hard for you guys, and it's really hard for the auditors to do that. And what I mean by that is we'll go into a lot of entities and they say, okay, here's a grant agreement. You go, fantastic, here's the accounting treatment for that grant. They go, great. Well, what about the rest of the grant? You mean what about the rest of the grant? They won't all have the same terms and conditions. You vary the terms and conditions and you'll get a different answer. And that makes it so hard to comply with this and to actually figure out what your answer is. Because if you're in a situation, I was at a client a couple of weeks ago, and they had something like 800 grant agreements. Now, is it fair for me to tell them they've got to review all of those 800 grant agreements? Probably not, because we haven't got the time to do that. So we have to go, okay, what's material? What's done and dusted within the 12 months in your reporting period? Because if you receive money on the 5th of your junior end, 5th of August, all fully spent and everything you were supposed to do by the 8th of May, do what you like. I don't care when you recognise revenue. Because at the 30th of June, your financial statements will be correct because you would have recognised it all. So we have to kind of try and be a little bit pragmatic around that and say if it's all done and dusted in the financial reporting period, we don't need to worry about it. We can just recognise that revenue whenever. If it's not material, what do we do about those? Challenge with the immaterial grants. You might tell me that every one of your grants is immaterial. If they all accumulate up to a material figure, we can't ignore the lot of them. So how are we going to do that? So we need to be thinking about how are you going to review the grants? How many are you going to review? How are you going to aggregate them? How are you going to be sure that your financial statements are not material mistakes? It depends. It depends on those terms and conditions. If you're in a situation where you might be the New South Wales branch of a particular organisation and you've got every other one of your organisations doing the same thing or similar thing and receiving the same grants, talk to each other. And that sounds like a really silly comment, but we're finding that everyone's working in silos, going, I've got this agreement, I must review it. Well, actually, so have another 6 entities. If one of you reviews it, saves time for everybody, and you've all then got consistency. So have a think about if you're in some sort of consortium type arrangement, can we just review these agreements once and get the same answer, which will save time for everybody. And everybody gets a grant each. Everybody reviews one grant and gets the same answer for that one grant, and then you've got the work of 6 grants already done. Other similar entities do not necessarily have the same terms and conditions, or they might have got it wrong. And the reason I put this in is because lots of for-profits would come back to me and they go, but look, we've got a listed competitor and they haven't said that we have to, that they're doing that. Yeah, but you don't know what their terms and conditions say. And actually, I probably they've got it wrong. Why are we assuming that they're right? One of the things that ASIC did is when they reviewed financial statements is they said these 6 entities are in the same industry. They do prima facie exactly the same thing. Why have they all got a different answer? Is that right? Maybe. Maybe because of the terms and conditions, or if some of them got it wrong. So they're actually going into these entities and kind of doing a hold on, why are you all different? So we can't assume by picking up somebody else that they've got it right and therefore what you've been told is wrong. If entities didn't give AASB 15 enough time, effort, and love, mistakes may well have been made. We found that lots of situations people just thought there's no impact. How do you know? Well, you didn't. Why would our revenue change? Because we've got a new standard that is quite different from the old standard. I know that you guys aren't sitting there going, so glad there's 2 new standards coming out because I was worried about what I was going to do next week. I had no work to do. I know that you are really busy, but we have to find the time for these particular standards because they are the biggest change we've had in a significant number of years. There is no big changes coming after this. There's going to be some minor tweaks. There is no big changes. So we really have to make sure we get this right. There are likely to be changes over the next few years, and I don't mean changes in standards, I mean changes in the treatment of these standards. We realise that actually we didn't do this right in year 1, and we got a little bit better in year 2, but then we still didn't get it completely right. So just bear that in mind as we go through. We need to make sure that we're spending the time to do this. Unfortunately, you're not going to walk out the door today knowing exactly what you have to do and what your changes are going to be under these standards, but hopefully at least I can help you some in regards to the issues. So some of the issues I'm seeing in the not-for-profit space, I've got up here, and I'm going to talk through a lot of these as we go. I'm going to spend a fair bit of time talking about principal and agency because it's an area that I think people are finding the most mistakes in. I'm going to look at a decision tree around contract cost assets and have you got those and should you be recognising them. Think about your terms and conditions of your contracts. Most of you in the room are from finance areas. You aren't negotiating grant agreements. You aren't writing proposals to try and get grants. Somebody else within the organisation is. Have you even had the conversation with them to tell them that the revenue standard is changing? Possibly not in many situations. If we can get those people on board, they don't care about accounting standards, I get that. But unless you actually tell them there's a change and tell them why potentially we need to report things differently and we need to pull apart things like performance obligations, the only people who this is creating more work for is you. So if we can have that conversation and say, can we possibly write our tender documents, our proposal documents a little bit differently? Can we focus on what is the promise, what is the performance obligation? And then that will feed all the way back up for when you do the revenue, because it'll be clearer. In order to put in a tender or a proposal for a grant, somebody's got to have costed it. Because if you're asking for $150,000, you've worked out that that's how much you need. Now, if that could be costed on a performance obligation basis, life's much easier. The answer's already there for you when you actually win that and come to do the revenue recognition. Whereas if we just keep going the way we have, you get to it, you're reviewing the grant agreement that you don't work with on a day-to-day basis, and you've got to try and figure out the answers. Upfront fees are still causing huge issues. And the reason that upfront fees are causing so many issues is because they will not meet the definition of a performance obligation. So a performance obligation, remember, is all about that benefit. Can the customer benefit from whatever it is that you've provided? And they have to genuinely be able to benefit from that thing that we've provided. So if we take something like I'm charging somebody an upfront fee to join my membership organisations, not the annual fee, it's the upfront fee, the setup fee, whatever we choose to call it. What benefit do they get from that? They don't. All they get is the benefit that they can pay their annual membership fee. So they get the benefit of that over time. So whereas we used to just be able to recognise a $500 joining fee up front, that's now got to be spread over the expected membership life. That's same for things like setup fees. Many grant agreements, the government will put a setup fee in there to allow you to spend some time setting them up in the system. What benefit do they get? None. The benefit is as that work is being done. So anything that's an upfront type fee, I don't know if we've got any schools in the room, enrolment fees, that type of thing, will need to be spread over the term that benefit, that service is being provided. Questions on upfront fees? Normally the one that people go, oh, I hate that accounting treatment. Contract assets and contract liabilities. Contract assets are effectively your WIP. So you're doing some work, you're accumulating costs, but it hasn't crystallized into a receivable. You haven't actually issued the invoice. So contract assets are that WIP type balance. The challenge around contract assets is it's not a financial instrument because it's a WIP balance. However, the standard says for the purpose of testing impairment, you test it the same way that you do a financial asset. So therefore you are required to do that expected credit loss testing on that. So if you are accumulating lots of costs, you're not getting the money up front, just be aware that that is subject now to impairment testing. Contract liabilities is the new terminology for income received in advance, deferred income, whatever you choose to call it. I have still seen a number of financial statements that have gone out there that have had one line called income received in advance and another line called contract liabilities. They're the same thing. So just make sure that we're understanding if you are receiving income in advance, and I know there's still a lot of government departments who will pay up front. Seems to be dropping a bit, but there's still a fair number of them. That is a contract liability if you are in the scope of AASB 15. But you received the money, but you haven't yet done what you are supposed to do. Which standard is the big issue for the not-for-profits? Because we've given you two accounting standards on revenue. SDR 15, which is based on our international standard, IFRS 15, and that's called revenue from contracts with customers. That's what it deals with. So if what you've been given is some money to go, love the work you're doing, here you go, have some money help you fulfill your objectives, that's not a revenue from a contract with customer, because I wouldn't give that money under those conditions to any for-profit entity. If you've been given money that is very specific, that tells you what you need to do with it, then you're going to be in SDR 15. Requirements in the standard is it has to be enforceable. We have to have a performance obligation, which requires a transfer of goods or services, and that performance obligation has to be sufficiently specific. So the absolute first thing that you guys have to do every time when you're looking at your revenue is work out which standard you are in. Very different accounting treatment depending on which standard we're in. We'll talk about that as we go through the session. So there's some of the issues that I'm seeing in the not-for-profit space. As I say, I'm going to talk more about principal agent and performance obligations. I said that we're hearing a lot of comments about if there's no impact. There's no impact at all under this standard. I thought it was useful to see a comment that the UK FRC put out. Now, the advantage of looking at the UK, it's not a great advantage for you guys because not-for-profits over there don't look different. But they're all December year ends, they're listed. So the FRC are always kind of 6 months ahead of where we are. And I thought this comment was really interesting. So where the impact of IFRS 15, or SDR 15 here, was reported as not being material, we considered whether significant judgments made in reaching this conclusion had been adequately disclosed and whether the accounting policies and disclosures reflect the new requirements. What that's saying is we had a lot of entities that said there was no impact in SDR 15. What we want to see is disclosures around why you've done that. Can we actually read your financial statements and be comfortable that you have actually done the work on these new standards? Have you changed the accounting policies, or do you still refer to we recognise revenue when we transfer risks and rewards? That's under the old standards. So even if you've had no change at all, we want to see that you've updated the accounting policies. We want to see that you've updated the disclosures, because the disclosures under these new standards are significant compared to the old standards. So if your conclusion is zero change, there should be a work paper that should be available to the auditors to look at that. And you need to give a story in the financial statements. If you're just putting one liner in to say the adoption of the revenue standards caused no change to the financial statements, I want to know why. Because when I read the financial statements with quite a cynical view, my response is you've done no work on it. You've just put that in as a blank comment. And that's what the UK FRC is saying. Where you're saying that the impact is not material, have you actually disclosed why? The judgments, the estimates that you made around this. Just bear that in mind when you are compiling your financials. The next comment I just want to raise is I've been looking at accounting policy papers that entities have been putting out. And what I'm concerned about is blanket comments that are being put in some of those accounting policy papers. Because as I said already, often the right answer is it depends. So this is from an accounting policy paper that a client put together. And they said under the current accounting practice, it's the type entity, so let's say the entity, recognises revenue when they receive control of the right to receive the grant or cash, normally on receipt. The following journal is processed, debit, cash, credit, revenue. Completely 100% correct under 1004, the old standard. Under SDR 15, this will not be the correct treatment, as revenue will have to be deferred and recognised when or as the performance obligation is satisfied. Is that true? I started off by making a comment that I said that not-for-profits wanted to defer all of their revenue and hoped we were writing an accounting standard that said you could. That effectively says you can. You can't. You can in some situations, but this was an 84-page position paper. Fairly big not-for-profit entity. This was on page 2. So when I started reading this, I had massive issues already on page 2 and had concerns with the other 82 pages being completely wrong because this is what it was based on. That's not true because we need to look at the individual terms and conditions. We need to even look at which standard we're in. This just assumes that there's only one standard and everything can be deferred. So we have to be really careful. I said I need a policy paper. This is the policy paper. This is the accounting policy paper. This is the but I need a policy paper that's right and that actually considers your circumstances and makes sure we've divided up. Even if you're in 15, it may be that actually you've got different performance obligations, and some of them you still do recognise early, and some of them you do defer over the life, some of them you recognise at the end. So just be careful about when we're doing this, making sure that we're actually using the right words from the standard and we're considering the right methodology. So I said one of the biggest issues was which standard we're in. And I said that there are 3 conditions: an enforceable contract, a performance obligation, and sufficiently specific. So enforceable, the easiest way of demonstrating that is refundability, but often we don't have refundability clauses. I was quite shocked when I started reading grant agreements, and I've read more grant agreements in the last 3 years than I ever want to read ever again. And I assumed naively that every time somebody gave somebody some money, there would be a clause in there that said, if you don't spend it on the right thing or you don't spend it all, you have to pay it back to me. And I say naively because I am still shocked every time I read these grant agreements, and there's nothing like that in there. Now, from a governance perspective, I would have thought the fund provider should be able to pull back the money fairly easily if they don't spend it. If you've got that refundability clause, it's easy. Tick, it's enforceable. If you don't have that, how else can we prove it's enforceable? What I'm looking for is the fund provider has the ability to slam their fist on the table and say, you haven't done what you're supposed to do. Under this contract, we can force you to do what you're supposed to do, or we have to receive some compensation for the fact you haven't done it. If we haven't got that, we automatically fail our enforceability and cannot be within 15. Because again, there's no way I would give money to a for-profit entity without some enforceability in relation to that. The next thing is we have to have a performance obligation. Now that performance obligation is a transfer of goods or services to somebody. This is really important for any not-for-profit in the room who receives, we'll call it capital grants, where I am giving you some money to build something or to purchase something that you are going to use within your organisation that will sit on your balance sheet. I'm going to give you some money to build a community health service, community health centre, for you to provide health services from. That community health centre is sitting on your balance sheet. You are not transferring it to anybody else, therefore you do not have a performance obligation. You cannot be within AASB 15 if you have received money to acquire or construct an asset for yourself. I'm going to talk about that later on, but I just want you to keep thinking about that. If you do have a performance obligation of transfer of goods or services, that transfer has to be sufficiently specific. So it has to be really clear what you have to do for your money. I read many grant agreements, and the comment I write on it is, I don't know what you have to do for the money that you received. And not-for-profits will say to me, yes, we keep it deliberately flowery. And say, why is that? So we can decide what we do with the money. If you can decide what you do with the money, I wouldn't give a for-profit money and let them decide what they're going to give back. So the more flowery it is, the more discretion you have over how you spend that money, it will not be sufficiently specific. That is where the biggest judgment calls are going to be from the end of the year when you're talking to the auditors. So document it. Tell me why you've actually come up with this decision that you have. If you meet each of these, you will see there is very clear pluses in between. It is not or, it is and. You are in AASB 15. AASB 15 is probably one of the most complicated standards that we've got. So why would you want to be in there? Because it will give you the answer that you want. That is where you are allowed to defer the revenue. That is where you are allowed to match. So if you are in there, you get the accounting treatment of either you recognise revenue at the end or you spread the revenue depending on your control transfer. If you don't meet those criteria, you are in AASB 1058. 1058 is our replacement standard for 1004. It is a purely Australian specific standard, and generally you are recognising revenue on receipt, which is what not-for-profits don't love. But if you don't meet those criteria, that's where you end up. So let's have a look at some of the key points in AASB 15, and then we're going to flick back to AASB 1058. I said performance obligations was one of the biggest issues, and it's not very often that I put extracts from accounting standards in my slide. But because people are just not necessarily understanding this concept of performance obligations, I've put it in there to show you the relevant parts of the standard. A performance obligation is so important because we account on a performance obligation basis if we're in 15. We don't account on a contract basis. We are required to, I think the word unbundle has been made up for the standard, but we unbundle the contract and account for performance obligations. So every time there is a specific promise to the customer or the client, whatever you call them, you are required to account for that as a separate performance obligation. So if you don't correctly identify what those promises are, you'll get your accounting completely wrong. So we have to organize this. We have to work out in our grant agreements, in our other revenue agreements, what are the specific promises. The performance obligation is something that is separately identified within the contract and is something that is distinct that the customer can benefit from. So we need to say, how are we doing that? How are we writing it? People will say to me, we can't change grant agreements and it's not clear within the grant agreement. I agree with you. But what you can control is the document you write to apply for that grant. And if you make that specific, if you make that very clear what the performance obligations are, again, it will make life much easier going forward. Because when you receive that grant, it will be linked to the proposal document. The money would have been awarded in accordance with the proposal you submitted to. When we think about things that aren't performance obligations, this is actually staff FAQ. Now, the SSB staff have been trying to put out some frequently asked questions in relation to these standards. They are available on the SSB website under the Hot Topics section. Staff FAQ does not come to the board. It has zero authority at all. However, I acknowledge that it is on the SSB website. So as much as I can stand here and tell you it has zero authority, it's available on the Accounting Standards Board's website. So it probably has a little bit more, I guess, credibility than some of the other things that are put out there. But having said that, as a board, we don't generally get to see these at all. This is in relation to research grants. Very specifically, it's in relation to research grants. So a lot of the words in there are talking about research. The reason I put it up today is it actually provides some really useful information for all not-for-profits. What it does is to say this is the output that is in the agreement, and do we think that meets the definition of performance obligation? Because lots of the times I hear, we've got to give a progress report, that must be our performance obligation, or we've got to payment milestones, that must be our performance obligation. They're not. So if we take things like you have to submit a progress report, typically, it is not a performance obligation because the progress report just says we're doing really well, we're on track. That's great. What benefit have you transferred to the fund provider? None. So this can be quite useful when you're actually going through and going, what do Cameron say about the progress reports, about the provision of a financial report? As I say, available on the SSB website, and it's mainly just things that do not meet the definition of a performance obligation. I want to think about performance obligations and in particular principal versus agency. So I'm actually going to flick ahead 2 slides and then I'm going to come back. Principal versus agency is all about performance obligations and our promises. And in the not-for-profit space, we're seeing that this is actually quite common. It's common in a couple of ways. Firstly, you may be part of a consortium, and that consortium puts in a grant proposal, let's say, and you're all working together on something. Who's actually got the obligation? Is it just the lead person who submitted the grant, or is it actually all the individual people? It also is really common in the NDIS space that we have situations where you might have a case manager, and that case manager receives all the money, but they're not actually responsible for providing the services to me. They're responsible for arranging for the people that I've nominated to give my physio, my counselling, whatever else I need. It's just that they're the pass-through for the money. So principal versus agency is all about the promise. What am I promising to do for the customer? Am I promising to provide the specific good or service itself? And in which case then I'm the principal, I recognise revenue, gross expense, because that's what I'm responsible for, providing that good or service. Or is my only responsibility in relation to arranging somebody else to do it? Effectively, I'm just a pass-through. Yes, I've received the money, but I have to organise somebody else to do the work, and they've got the responsibility. It's purely because the NDIS, for example, don't want to deal with hundreds and hundreds and hundreds of providers. They want to deal with less, and we let that one provider deal with the 5 providers that I need. So are we responsible for providing the service, or are we responsible for arranging it? I think you'll find in some of your agreements there are quite a few that your only responsibility is to arrange for something else to be done. Yes, you've collected all of that money, but you have no obligation to that except to pay it back out. So all you are able to recognise is any commission, if any, that you are entitled to. Debit cash, credit a financial liability, because that's your obligation to pay it back out. It is not debit cash, credit revenue. And we're seeing in the not-for-profit space there's a fair bit of that's happening, and reductions in revenue. It also reduces your expenses, so it has no change on the bottom line, but just bear that in mind. Now I'm going to flip back a slide. When we're thinking about those promises and those obligations, this is what I've seen in a few position papers around. Every one of these justifies why they're a principal, why they've got primary responsibility. So I just wanted to think about which of these are actually relevant. So in the first one, I've got that this particular entity is responsible for receiving the funds and coordinating with other entities to ensure funds are distributed, used, and accounted for effectively, as well as ensuring that all plans and reports under the agreement are developed. Does that comment affect whether I'm a principal or whether I'm an agent? So remember, being a principal is, am I responsible for providing the goods or services? Do I have primary responsibility? What am I doing here? Just doing some admin stuff. There's actually nothing about the goods or services. So that has no relevance at all to whether I am primarily responsible for providing the good or service that is being required under that agreement. In the second one, well, I'm the entity who made the grant application, and I'm the one who liaises. Does that mean I'm a principal? No. Just means I'm the one who ended up having to do all of the work to talk to the people. Might be that I get paid a commission for doing that, or a project management fee, and that's what I earn, but it doesn't mean that I'm actually the principal of the whole thing. Notwithstanding that I may have subcontracted some of the obligations under this agreement, I remain responsible for the performance of the agreement. I am required to do everything to give effect to this agreement. That's what I'm looking for. That tells me that it doesn't matter if I've got other people and I've sent money to them, etc. I'm the one who gets all of the obligations under this particular agreement. I have primary responsibility. If it all goes horribly wrong, even though everybody knows I've subcontracted it, it's me who has to fix it. So when we're thinking about this principal versus agency, we've got to make sure we're really looking at the promise to the customer, not the admin stuff in the first proposal. So I would strongly encourage you to be looking at these agreements, because we are seeing a huge number of agreements that do have some requirements as an agency. Questions at all? No. Yeah.
On the staff aid FAQs, you provided all of those that don't fall under performance obligations. Can you just at least give one example where there is a performance obligation?
So performance obligation, let's say that you were being paid to vaccinate children. So the performance obligation is you have to vaccinate 500 children. So every time you vaccinate a child, that's one performance obligation, because that benefit has been transferred. So a performance obligation is about the good or service that you're providing, not about, have I given you a report to say, by the way, in February, I vaccinated 5 children. So the actual vaccination is the benefit, is the promise. The report telling you that I've done it isn't. So your performance obligation is about performing the good or service, not the admin tasks that come with it. Yeah, so research grants, causing all sorts of issues at the moment. Research grants, in many cases, the obligation might be the report, because that's all you do. You do not allow anybody access to your data. You don't allow anybody to see what you've done up to, the preliminary stuff. All I have to hand to you is that final report, and you still don't get access to any of my underlying information. you don't get to interrogate the database, you don't get to look at it, then that could be the performance obligation. Whereas if in a research situation, I'm doing the work and I'm collecting the data, and you have the ability to come in and have access to that at any time that you want to do, or I have to put it out on an open source type platform, then that's my obligation, is getting that out there. So research grants is challenging, as you say, because they're flowery, but also what is my obligation and how much am I keeping to myself and how much am I actually putting out there? What am I actually giving you as the fund provider? And it varies dramatically in these research arrangements.
How do you reconcile two facts? One is, in this particular case, you make a commitment to vaccinate 500 children.
Yes.
But the funds coming from a donor who, by the concept of donation, has no right for performances.
Yep.
So you receive $500 and you make a non-enforceable commitment to a donor. But in one financial year, you can only do 450. So you propose to recognize only 450 of that donation.
So the way I reconcile it is, the first step is, which standard am I in? Because it's not an enforceable contract, I'm not within 15, which means I'm recognizing revenue on receipt. So even though as a donor you say to me, I'm giving you this money and I want you to vaccinate 500 children, but you know what, if I don't, nothing you can do about it. I fail that, I can't be within 15. So the concept of performance obligations only kicks in when I'm in 15. Otherwise, it's generally cash on receipt. Any other questions so far? Yeah.
If I have a constitution instead of a contract, does that make it enforceable?
So when you say you have a constitution instead of a contract, what do you mean by constitution? Constitution is normally about how to set up an entity.
Yeah, so we're a membership.
Yeah.
So there's no contract necessarily, it's just pay to be a member for the year. And I guess what that entails is set out in the constitution.
Yes.
Something signed every year.
Right, gotcha. No, it makes no difference though. A contract can be written, verbal or implied. It doesn't need to have the word contract on it. And I guess when I'm thinking as we were talking, as I pay over my institute fees every year, I don't get to sign anything. I just get, and I probably don't even get told what I'm given. I just have to hand the money over every year. So that contract would be implied by that constitution, and probably when I joined, maybe there was something inside. I don't remember. But no, it could be implied within that.
And what are the performance obligations of the membership organization?
Yeah, so I'm going to come back to it depends. It may be that you are providing me with a magazine 4 times a year, and you've said you're going to do that. It may be that you're providing me access to all of the resources on your website and have the ability to access that for 12 months. So generally, we would say that there is something that I'm getting for that, and it's often access to resources. Because I have access to that over 12 months, we would generally be spreading that annual fee. It's different from the joining fee, the annual fee over that 12-month period. Again, if I apply pragmatism, the right answer is to spread it over 12 months. But if you receive the money early, let's say you're a junior end and you always receive the money in June the previous year, and you kind of get the same amount every year, is it material if you recognise it all on receipt because you kind of have the same thing? Maybe, maybe not. It's an analysis. It's not different because you're only looking at materiality of the delta, and you've got the same number of members every year. Don't get too upset as long as you can kind of prove to me that what you're doing is okay. But your policy is still, you spread it, and it's just not looking at that. Any other questions? All right, let's keep moving through. So the concept under SSB 15 is control transfer. When have I transferred control of the performance obligation, the benefit, and that's when I recognize the revenue. So how do we know when we've transferred control? Bit of a decision tree here for us. So the first thing is, does the customer control the asset? When we talk about asset, we're not talking about something that I'm building that I can see. We're talking about could be a good or a service. So if we think about something like an audit fee and an audit, the performance obligation is handing over your audit opinion, the asset that's been created is the audit evidence. Now, that's not something that would ever be recognised on the balance sheet. So that evidence is what are you doing? Sorry, the asset is what are you doing to actually complete that good or service. So don't get caught up in, I don't have an asset, I'm not building a laptop. That asset is a service as well. So do you give the customer control of that as you're doing it? And research is interesting because it depends. Sometimes you do, sometimes you don't. It depends what access you're actually giving people to the data and how you release that. Does the customer receive and consume the benefit as you do the work? A good way of thinking about this is if you were to get rid of the supplier. So I'm doing some work for you and you decide to get rid of me for whatever reason. And new person comes in. Would new person be able to pick up the work that I've done? If I'm 40% of the way through, would they be able to continue and only do the remaining 60%, or would they have to start from scratch? So if, for example, I was getting a parcel delivered from the UK to me in Melbourne, and the parcel arrives in Hong Kong, and for whatever reason, I decide to change my courier. The new courier wouldn't have to return the parcel back to the UK and reship it. They'd pick it up from wherever it was in Hong Kong and continue shipping it to me in Melbourne. So I'm getting the benefit every time that comes in, every kilometre. Contrast that with the audit. If you got rid of your auditor for whatever reason, new auditor, there is no way that the old auditor would hand them the audit file. They're starting again from scratch. So would the new person be able to pick up from where the old person had started? Or do they have to actually go back? It's a really good way of thinking about that. Do you receive and consume the benefit of the work done? Does the asset have an alternative use to you? So you're creating this thing to help you do the work. If it was to be, contract was to end, what can you do with what you could be created? If it is very specific to the client, the answer could be nothing. If it's, well, we could try and sell the research to somebody else, but we don't think that there's anybody out there, or we've built something, or we've designed training programs for a particular education program that we're doing, but in order to do it, sell it to somebody else, there's a fair bit of work we would have to do to create that. The answer could be no, there isn't an alternative use. If it's yet what we've developed is just some plain vanilla training program to help in, let's say, governance in the not-for-profit space that we could roll to lots of different people, well, then it could have an alternative use because there's lots of other people who might be out there that want that. If we do say we've got an alternative use, we transfer control at a point in time, which means we recognise revenue at that point in time and we hand it over there. That's when we recognise the revenue and we hand over the good or service. If we say it doesn't have an alternative use, which is often the case within service type arrangements in the not-for-profit and for-profit space, we then have to ask, do we have an enforceable right to receive payment for work performed to date? Now, what that means is at any point in time, if the contract was ended and I've done 40% of the work, do I have a right to invoice and receive payment for 40% of that project value? It's not just the cost that I've incurred, it's not just reimbursement for that, it is cost incurred plus a reasonable profit margin. Now, I know in the not-for-profit space, you often go, we don't have the profit margins. You do, because there's no way you can survive. You've got to recover your fixed costs. So there is always a profit margin in everything that you're putting in. So do you have the right to actually claim that back? If the answer is yes, you can spread the revenue. If the answer is no, you recognise the revenue at the end of SDR 15. So if you've got a contract that you want to spread as you're doing the work, the only way you can do that is if you've answered yes to one of these three questions to get into this box. If you answer anything other than that, you are down here and transferring at a point in time, which is 1 point recognition. When you've completed the performance obligation, remember I'm counting on a performance obligation, not a contract. So for all of the agreements that you've got, once you've identified the performance obligation, you've then got to come back to, when do I transfer control of that? When is it that they get a benefit? Questions, comments, Dawn? I talked about costs. There are two types of costs that are recognised within SDR 15. One, I don't think will have huge prevalence in the not-for-profit space for the vast majority of not-for-profits, and that is a cost to obtain a contract. If you do happen to pay sales commissions at all to people who, you have the people in the streets who accost me whenever I'm in a rush, and you pay commissions to them, that would be captured by that. But And we're assuming that the majority of you probably don't. So if we're looking to cost to fulfill a contract, this is where, for example, and I'll come back to my vaccination example. I'm in 15, so it's not a donation, it's through an enforceable contract. And I've been paid this money up front. I can't recognise revenue until I've donated children, until I've vaccinated children. But I have to incur some costs. I have to go out there and I have to employ a nurse. And I have to do some promotional stuff to actually tell everybody that these are happening. So I'm incurring some potentially fairly significant costs. It's quite a big program. Traditionally, I would have expensed those, and then I would probably have gone, well, I'll just recognise the revenue because I've incurred some costs and I'm doing matching that way. And to this standard, that concept doesn't exist because it's all about revenue recognition. I have not vaccinated a child, I cannot recognise any revenue. So I then look at the cost element. Are the costs incurred within the scope of another standard? If the answer is yes, you deal with that other standard. And that could be property, plant, and equipment, it could be intangibles, it could be inventory. Whatever it is, that's the standard you keep into. For my recruitment costs and my promotional costs, the answer is no. Do the costs relate directly to a contract? Yes, they do. The only reason I went out and did all of this work was because I'd won this particular grant. I wouldn't have done it otherwise. Do the costs to generate or enhance resources used to satisfy performance obligation? Well, yeah, the only reason I've got it is to create this person who is going to go out there and do that vaccination. Are the costs expected to be recovered? Assuming I've costed it correctly in my proposal stage, yes, I would expect them to be recovered. So then I come down here, I am required to capitalise those costs. So I capitalise those costs and I release them when I vaccinate the children. Let's say I'm vaccinating 10,000 children. Every time I vaccinate one child, I would release 1/10,000 of that revenue, of that expense. I know I'm not going to do it like that. I know I'm going to do it at the end of every month or at the end of every year. But the concept is every time you recognise that revenue, you release the associated expenses. So we have to be thinking about, do we have these costs that we're incurring that meet these criteria that we are required to capitalise? They get capitalised as a contract cost asset on your balance sheet. So we're all very focused on revenue, but what about the associated costs? Questions, comments at all? Yeah?
I don't know if there's a mismatch between the timing of two contracts. I've got a situation where we enter into one contract, we subcontract technically.
Yep.
Our under the individual contract. But there's a small timing difference. So one contract, the expense, if you like, the cost ends a number of months, like 3 months earlier than the revenue.
So you're still completing a performance obligation, but all the costs have been incurred.
So and that cost of the year end. So
yep.
I might have the cost contract finishing on my year end.
Yep.
But I've got revenue that's straddling.
Because you still have to do the work.
Well, it's
so I'm challenging you that to kind of go, don't assume that what you've done in the past is right. Do you still have work to do after year end? And that work. Okay, so it's actual work. It's not just I've got to do the final report. Yeah, because remember that I'm looking at have you satisfied your performance obligation, and just signing the financial report, completing the financial report is not a performance obligation. So in many cases, I would say my gut instinct is because your costs are finished, I would suggest you've probably completed all your performance obligations and you just have back up to do. So then I would have said you probably should be recognising all your revenue and all your costs. If it's not, if it's a situation that you still have performance obligations to satisfy, absolutely you would look at this and go, okay, well, I've incurred these costs, but they still relate, and maybe a portion of that gets capitalised. But I'm suspecting that if your costs are finished, and it's those costs incurred to complete a performance obligation, I reckon you might have completed everything. Yeah. In relation to disclosures, as I've already mentioned a few times, the disclosures under this standard are significant. And we haven't seen very many entities early adopt this in the not-for-profit space. The one that we have seen early adopt it is CPA. And CPA are a December year end. They early adopted this at December 2018. So the reason I've put this up is just to show you one of the disclosures that is required by this standard, because disclosures are always the bit we forget about at the end. And then we suddenly panic when we realise that actually there's significant disclosures. One of the disclosure requirements under AASB 15 is that you have to disaggregate your revenue. So similar to what we would see in a listed space with a segment, this is going further than that. This is actually saying, tell us how your revenue varies based on various risks, uncertainties, etc. Some of the ways we may disaggregate is by type of business, by how we recognise the revenue, whether it's point of time or over time, type of customer. If you have a customer that's a government customer versus a non-government customer, very different risk profile in relation to that. Geography might be a good way of disaggregating it. So it's just to show you the level of disclosure that's needed, what CPA have chosen to do. They did restate, so that's why there's 2 years here. They chose to restate their comparative. They've done their revenue and they've split it by timing. This is how much revenue was recognised at a point in time. This is how much revenue we're recognising over time. So that's based on the performance obligations and when control transfer is satisfied. And then they've broken up their revenue into the different types of revenue streams. So you can see it's actually quite useful information, but it can be a fair bit of work for you. And potentially you are giving some information out there that whilst you're not in that necessarily, commercially insensitive space, there may be some bits of this that you go, I'm sure we actually want to tell people. So just have a think. This disclosure exists. There is no exemption from unreasonable prejudice or anything like that. Have a think about how you are going to disaggregate your revenue. If you are saying you can't disaggregate it, I probably don't believe you, because I don't think you have only one type of customer in one geographical space, and all the services are the same, all of the revenue recognition is the same. You may be able to put an argument to me, but in the vast majority of cases, there is some disaggregation that is appropriate. So just have to think about that. So how do we adopt this standard? I suspect most of you will be using the modified approach, and that's consequently the only one I'm going to talk about. So with the modified approach, I've assumed a June year end. Your opening balance sheet would be the 1st of July 2019. Modified approach means you do not restate comparatives, and that's why the opening balance sheet date is the beginning of the current year. So what we end up with in the financial statements is in the current year, we have the numbers that are in compliance with AASB 15, AASB 1058. The comparative year, the numbers are under the old standards. So we've got AASB 111, 118, and 1004. Revenue is arguably one of the most important numbers in financial statements and is often the biggest. Yet we have zero comparability. And that makes no sense. And the International Board realised it made no sense. So we can't get comparability on the new standards because the board has told you don't need to restate. Therefore, there's only one way we can get comparability on the old standards. So what you are required to do, you are required to present the current year numbers under the old standards. Tell me what your numbers would have looked like if you had not adopted AASB 15 and AASB 1058. This is a disclosure that caught a lot of the for-profits out. On the other side, because they were so unorganised, their ledgers were already running under the old standards and AASB 15 is a previous 13 adjustment. But you just need to be aware of this. If you have been beautifully organised and your ledger is running under 15 and 1058, fantastic. Just make sure you've got the ability to get the numbers and what they would have looked like under the old standards. If your ledger is still running under the old standards, you've got the easy answer there. You've just got to do those adjustments into 15 and 1058. So that is a disclosure that is required, in my view, regardless of whether you're doing special purpose or general purpose. Because if you just put this in, I don't believe that anyone can sign off that those financials present fairly, because you've got zero comparability. Questions at all on that? So let's move on to 1058. 1058 is a standard we get into if we do not get into AASB 15. It is a much easier standard than AASB 15, but not-for-profits do not like the answer because it gives a very similar answer to what was in 1004. The way we wrote this standard, it's not the most plain English standard, I appreciate that. The way we wrote this standard is from a balance sheet perspective. So 1004 used to say debit, cash, credit, revenue, and that was pretty much it. What we now say is, okay, we acknowledge that not-for-profits don't like that. We need to have an accounting principle in order to be able to write a standard. So let's make it a principle that's based on balance sheet rather than the income statement. So the first thing that you do is you recognise any asset that you have received at fair value. If you have paid significantly less than fair value, you are able to, or you have to, fair value that at day one. So you have to recognise all of those assets at fair value. So that's your debit on the balance sheet. We then say to you, okay, you've received an asset. What do you have to do because you received that asset? What's your obligation? And does that obligation meet the definition of a liability or equity in any of the accounting standards? So it could be, for example, that you have been donated a piece of land, and that land is to be turned into community use of one way or another. Looks beautiful, the land. However, it is highly contaminated. And before you can use it for anything, you've got to decontaminate it. So the first thing that we do is we debit the land at its fair value, because you haven't paid for it, you've got to fair value it up. And then we say we've actually got a liability under the provision standard. We have to decontaminate this land. So you would credit the liability, the provision, for however much it will cost you to decontaminate that land. What we then do in step 3 is we compare the debit with the credit. In my land example, there is probably a residual credit, and that credit is what goes to revenue. That's the free bit that you've been given. That's the actual benefit that you've been given. So we tell you to debit the asset, look for a credit. The credit may be that you're actually in AASB 15 because you've got enforceability of performance obligation and sufficiently specific. So your credit is then a contract liability. You're out of 1058, you're in the relevant standard. So instead of just debit, cash, credit, revenue, we put that middle step in and tell you to try and find any related liability. And the example that I was asked earlier about the donation, you are debiting cash, you've got no obligation because there is no enforceability, and you straight away just credit that revenue. So there will still be many situations where you are debiting cash, crediting revenue, but you are looking for that middle component first of all. That's the general principle in AASB 1058, much simpler than 15. There's one exception to this principle, and it relates back to the comment I made about capital grants earlier. We don't call it the capital grant exception within the standard. What we call it is the exception for assets controlled by the entity, but it's effectively most capital grants. So I've given you some money, and I require you to build a community health centre because you're in the business of providing community health services. I'm telling you that you have to acquire or construct an asset that will be recognised on your books. So it will be recognised as part of your PP&E to identify its specifications. So I'm telling you what it needs to have in there. You're not required to transfer that asset to anybody else because you are going to keep it on your books. And the agreement is enforceable. So if you don't do what you're supposed to do, you've either got to give me the money back, you've got to compensate me. If those 3 criteria are met, they are plus, they're not 4, then what we do is we say to you, okay, you can't be in 15 because there is no performance obligation. But we are going to give you the same accounting treatment as if you were. So on day 1, you would debit cash, assuming you have cash up front, and you would credit a contract liability. As you complete the asset, as you build the centre, you would release the contract liability to income. So you are recognising the revenue as you are completing the work. So as you are building that centre, that's when you recognise the revenue. So when we get to the end, you've got an asset on your balance sheet, you've recognised all the revenue, you've spent all your cash, you've released all your contract liability. So if you are in a situation where you have capital grants, particularly any capital grants that were received in the last week of June 2019, you can choose to restate this for the current year, and you're actually then recognising the revenue as you do the work. So I know that there was lots of not-for-profits that did used to receive lots of cash and had to do the whole debit, cash, credit, revenue, and then do that capital works in the next year. So a fairly big change. So let's just cover a couple of other things. Research income. I missed one SSB meeting in 8 years. This was the one that this was discussed, and this was, I've never had so much uproar. I was actually in Sydney on the day that this was held, and I was at CPA running a training session, and in another room was a research group that was happening, which was all the technical people from the mid-tier. And I walked past the room, and it was lunchtime, and I got accosted, and they said to me, "What have you done? What's happened in the board meeting this morning?" I said, "I don't know, I've been running training all morning." And I've never been accosted so much about this particular update that we went through. I mentioned the staff FAQs that are out there, and there's been some staff FAQs on research grants that when they were released, they were not considered to be reflective of the terms and conditions of a grant that it kind of looked like it was meant to be reflecting. So consequently, there was uproar. I said that staff FAQs don't come to the board. This one ended up coming to the board because of the controversy that had happened around it. What we did was we then amended an example within the standard to put some clarification around it, and we updated the staff FAQs. That was all done fairly late. This was in about November. So what the board agreed to do is said, okay, because this guidance has been kind of mucking around a little bit and it's quite late before the final ones come out, the standard was amended to say that entities who had research income could opt to defer the effective date of SSB 15 and 1058 only for research income if they so wish to. It only applies to year ends between the 31st of December and 29th of June. So if you are a 30 June year end, it does not apply. So the reason I'm raising it today is because if there is anyone in the room who has research income who did hear that they could defer the effective date of this standard and you're a June year end, don't get excited because it doesn't apply to you. If you are in that period where it covers, my personal view, and I would probably have voted for it because it was optional, my personal view is I think you are creating more work for yourself if you defer. Because if you defer, all you are doing is deferring research income. Every other element of revenue, you have to comply with 15 and 1058. So what that means is you've got 2 transition years. You've got a transition year to transition everything else with all the relevant disclosures for that. And then next year, you've got to transition again. And to me, it's just more work. But that is available if you are in that very short period of those year ends. Any questions at all on that? So what I want you to think about is your ongoing processes. Have you got one? How are you actually tracking your revenue? How are you actually tracking your agreements? How are you actually making sure you know which standard you're in and how do you account for it? Who's going to monitor these agreements? And when are they going to do it? Because we can't do it all at the year end. It has to happen throughout, because otherwise it will just be chaos. What documentation is happening? Who's documenting it? Where are we storing that? How are we comfortable with what we've actually done? When the auditors come out, what are we going to provide them to show that we've transitioned to this standard appropriately? And then on an ongoing basis, we've continued to look at these agreements. What I'm finding is entities are so focused on getting the opening balance sheet right that they then forget that actually this is continuous. This isn't going anywhere. So what process have we got in place to keep doing that? So I would strongly encourage you to start thinking about this. Any other questions at all on the theory of what I've gone through at all today on revenue? So I'm going to test how well you've all been listening to me. I've got a couple of scenarios for you. I've got a not-for-profit entity that has received a grant to replace an operational building that has collapsed. The money is being received prior to the work commencing. I can't even read, and must be repaid if it's not spent correctly or in full. Which standard am I in? 1058, perfect. Why? Because it's a grant. Did somebody really just say because it's a grant? Okay, now we're going to have to go back to the start and start again. So because it's an exception for a capital grant. So you said because it's enforceable. The issue with this is I've received money to build something that I am going to control. I am not transferring goods or services to anybody else, therefore I cannot be within SSB 15. I have to be within SSB 1058. So it is enforceable, but because I haven't got that transfer of goods or services external to the entity, coming 1058. I can use the capital exception because I've given you all the information that suggests I can. So how will I therefore account for it? What will I do when I receive the money? I'll give you half the entry, I'm debiting cash. What am I crediting? Contract liability. And I release that contract liability as I complete that building. So if you are receiving money to do something yourself that you are going to retain the benefit of that in relation to an asset that you would recognise on your balance sheet, 1058, and we consider that exception. Are we all comfortable with that? Yeah. But not-for-profit entity that has received a grant to encourage recycling in the local community, they are required to acquit it and all funds are refunded. Which stands the way? 15, why?
It's obligation. You don't own the asset.
Okay, what's my obligation?
To the project to build recycling.
How do I encourage recycling in the local community? Not specific. What do? I could put up lots of posters, go and please recycle. I could give everybody another brand new, shiny, silver, sparkly recycle bin. I have the discretion over how I do that. If that's all the grant agreement says, is you've got to, we're giving you some money to encourage recycling in the area, too much discretion over how we spend the money. Fully acknowledge that there may be a proposal that has lots of detail, it may be more detail in there, but based on that, if that's all it requires, and I see grants that have that vague an objective, so this is the objective of the money we're giving you, too much discretion over how you spend the money, so therefore I cannot be within 15, it is not sufficiently specific, and therefore in SSB 1058. How do I account for that money? I'll give you half the entry again, debit cash. Income, revenue on day one. So we've got to be looking again at that. What are we being asked to do? How much discretion over how to spend the money? How much choice have I got? Questions on that one? Anything else on revenue before we move away? So we didn't go through the theory of all of the standards because we've done that before. I really just wanted to kind of throw issues that I'm seeing.
Quick question.
Yeah.
Maybe a question. You said earlier in the presentation that you made a reference to you want to be in 15 instead of 15.
Yes. Yeah.
Why would they want to be in 15?
Because they don't, not-for-profits, in making, if the work's done and dusted in the year, they don't care. What the problem is in Australia particularly, is the government gets to the last week of June and they go, oh, I've got some money we haven't spent, and send it to the not-for-profits. And not-for-profits say to me, we hate checking our bank account in the last week of June because there's money's there, and that's when you have to debit cash credit revenue. So in 1 year, you're recognising all of this revenue. So for example, donors go, we don't need to give them any money, look how much money they've got, look how much profit that they've made. The next year comes around, you're spending the cash, you've got all these expenses, and everyone goes, wow, look how bad they are at managing their money. Last year they made all this profit, this year they're making huge losses. So that's the issue. It's that mainly funding that they receive towards the end of the year that haven't been able to spend. So not-for-profits really want to match the revenue and the expenses. Yep.
Which means that we represent people in a sort of nebulous, non-specified way. So that put me in, well, yeah, like, we don't know what will come up for the year at the start of the year.
Yep.
No plan.
Yep.
That put me in not 15.
Not sounding great on my own pay my membership unit so far, is it? Well, so what you're doing, and I'm putting words into your mouth, I know that, you're standing ready in case I need you.
Yes.
So that's what I'm paying for. So for every month of the year, I'm paying for you to stand ready, because if I need you, I expect you to jump into action and go and act on my behalf. That would be because effectively that you're acting as a peak body in my best interest. So if, as I say, it's kind of like a warranty. If you think about it in the warranty aspect, I may never need the warranty, and hopefully I don't. My equipment works beautifully, but if I need it, I use that warranty. So it's considered that your obligation to me is to stand ready.
Yeah. That's the encouraging recycling. I am operating on your behalf, not in a specific, put a posted way, but in a, should be decided, maybe this issue will come up, maybe we'll do it this way.
I don't agree, because it's there if you're acting in a certain way, and if, as I say, I need you to do something, that's your role, as opposed to, so you can't really necessarily decide. If I can come back and say, I need you to do this, I need you to act, and you have to act based on what I'm saying. Whereas encouraging recycling, you just have complete discretion over how you spend that money. I still think you'll find with your annual fees that make no difference. Yeah.
Can I just ask back to the example you gave before, the taking income when you get money and you have to produce?
Yes.
The next year you've got all your expenses to look like you have money.
Yeah.
How does that come when you're looking at showing the true view of your financial statement? Surely you're not showing the true view in that case, because these are grants that you get from the last you can be very to.
Yeah, absolutely. So if you didn't hear that, that was how does it show a true and fair view? To be showing all of the revenue in one year and all the expenses in the other. And as a board, we spent a fair bit of time thinking about that. What our issue is if you're receiving this cash that you are in control of, it's an asset to you, and you've got no obligation in relation to it that meets the definition. Well, you're showing the cash as an asset. So then you go, what's your obligation to it? And that's why when we wrote 1058, we very much went, let's then say, if you've got an asset, what's your obligation? And in order to recognize an obligation, you have to have a liability. You can't meet the definition of a liability. There's no other place to put it. It's got to go to revenue. And if you've got that enforceability, if you've got that sufficiently specific, you will now be able to defer it. If you haven't, if it's a donation, if it's just had some money and you know what, you can decide how you spend that. When you spend it, it's still a revenue because you're in control of that and it makes the definition of revenue.
So would you be encouraging?
Well, it depends, because your balance sheet will be misstated if you put it through as a liability, because you don't make the definition of liability. So it's not matching, but matching doesn't exist as a concept. And as I say, the balance sheet would be wrong if you recognise a liability. There's no stopping you disclosing it, and that's what we're encouraging entities to do. If you look in the Institute Not-for-Profit Guide, that actually shows it and says we've received this money, this is what we are going to spend it on, but there's actually no external restrictions around that. So what I would encourage you to do is make it enforceable, make it sufficiently specific, then you can defer it. If there's a reason you don't want to do that, that kind of indicates that it's probably more that there is control and not so much obligation. Somebody over here. Oh, that's the same thing. Yeah. Yeah. So it comes back to that. You know, if you've got something that's not enforceable or not sufficiently specific, and as I say, in many of these cases, you put in a proposal. Make that proposal sufficiently specific. Make it clear. In my recycling one, this is what we're going to do, and then the grant will be linked to your proposal. You get to defer. Any other questions on the revenue? Or move on to leases? Oh, all right. So leases is in place for everybody this year. We didn't defer the effective date for this standard. And therefore, what I'm going to talk about is not necessarily not-for-profit specific at all, because it's identical to everybody. I put some steps in for AASB 16. And the reason that I put these in is because when I'm working with a lot of clients, and I get lots of phone calls about this, and I get lots of phone calls that don't make sense because of the order that they're asking questions in. So the questions I get asked a lot is, can I get out of lease accounting? And how do we do that? And I've got lots of leases over laptops. They're not leases. So when we look at actually the process of it, there are ways to get out of lease accounting legitimately. And there are ways that are not legitimate and that people are changing agreements that expose themselves to such massive business risks. I think they're crazy to do it to avoid a standard. It's their decision. So if we work through these steps, and then we'll work through some of these in a lot more detail. One of the biggest issues that you've got is what is a lease. Just because a piece of paper is called a lease doesn't mean it is a lease. Just because a piece of paper is not called a lease doesn't mean it's not a lease. So look at all of the agreements that we've got in place, and does it meet the definition of a lease? And we've done definitions of leases today in these sessions before, so I'm not going to spend huge amounts of time going through it. I guess my key message is in relation to this, we've got certain criteria that have to be met. We have to have an identified asset, we have to have the right to the economic benefits, and we have to have the right to direct the use of a particular asset. It doesn't need to be called a lease. It could be a maintenance agreement, and within that maintenance agreement, there is specialised plant and equipment, specialised vehicles. It could be that it's a usage agreement. You might have, I've learned a lot about fibre optic cables when I've been doing these particular agreements. So there is fibre optic cables that many of us would have that gives us the internet to home. We just get what we get, and we use whatever we use. There are other fibre optic cables which many businesses might have, which are dedicated. This is a cable that the only thing that goes down there is my data. Nobody else can use it. Also this thing called dark fibre cables, which sounds much more exciting than it is, but you've got to look at things like that. Have you got something that is a dedicated asset to you, and effectively you're leasing that particular cable? Usage of pipes. If you've got exclusive use over that, or you're using 80% of the capacity of a water pipe, you've probably got a lease in place over that. So we're looking at all of these agreements that might be in place, as well as your traditional, I'm leasing a building, I'm leasing a car. What else might we have that actually meets the definition of a lease? IT server, if you're outsourcing IT server, could also potentially meet the definition. How do we find this? We look in the general ledger, we look for recurring amounts that are happening. We look at contract registers, we look at things we put out for tender where people have actually submitted quotes. We talk to people outside of the finance area and say, what type of agreements are you managing? Step number one is always working out, do you have any agreements that meet the definition of a lease? If it meets the definition of a lease, it's a lease. Regardless of what it's called, regardless of what the accounting looks like. Meets the definition, it's a lease. Then we move on to the two legitimate ways of getting out of lease accounting, and that is our exceptions to lease accounting. First one is in relation to short-term leases, that is leases of a lease term 12 months or less. The second one is in relation to leases of low-value assets. It is not low-value leases, and that's actually really crucial, particularly in the not-for-profit space, because people say to me, we only pay $300 a year, clearly it's low value. You pay $300 a year for a piece of land that's worth $1 million. That asset is not low value. So we'll talk about peppercorns a little bit later on, but it's about the value of the asset when we talk about leases of low value assets, not the payments that you're making. If you meet either of those two exceptions, you have a choice. You can choose to apply the exceptions. I would strongly encourage you to do so. And what you do is you account for that lease through the P&L as and when incurred. Exactly what you used to do for operating leases. Because it is still a lease, you are still in the scope of AASB 16. One of the disclosure requirements is that you have to disclose the expense related to short-term leases and leases of low-value assets. As you've got the ability in your general ledger system to capture that? Probably not. So we need to be looking to set up a separate account to be able to capture that, because it's much easier. At the end of the year, we can just pull all the information from that chart account. So then we work up and we say, what's the lease term? What's the length of this lease that we've got? And we'll talk a bit about enforceability later on, but what's actually the length of this lease? Sometimes it's easy. Sometimes we've just got a 5-year lease and that's it. It ends at the end of that. No renewal or other options. Other times we've got options. We might have a 2 + 2 + 2 + 2. We might be on a monthly rolling lease. We might not even have a lease. And that's common in the not-for-profit space. And if I say to them, why don't you go back and just actually get some formality and have a lease? Or because we actually don't really pay anything. And if we go back and ask for a lease, then the lessor might remember that we're here, and we don't want to do that. So that happens, and that's a business reality of what we see. What are the future cash payments? And how much of them are lease components? And how much of them are non-lease components? And do we want to separate them? So again, we'll look at an example in relation to that, and that's an accounting policy choice you've got. Then we look at the discount rate. This is causing all sorts of problems. We'll spend some time looking at that. Once we've got all of these inputs, we then get to calculate the discounted lease liability. We always do liability first, and the reason for that is because the right of use flows from the lease liability. So the right of use is the lease liability, we add back costs, we add back prepaid lease payments, we add on our make good provision, and we take off lease incentives. So unless we've calculated the liability, we can't come up with the right of use. And that's the way the standard operates. We always look at the liability, and the right of use is effectively a balancing figure. So some of the issues that I'm seeing in relation to leases, not here on the slide, I'm going to cover off each of these as we go through, but I just wanted to put it up there because it's a good check for when you're actually working through this to say, have I thought about these different components? I said that we've done what is a lease to death before. This is the definition, just as a reminder. Look, who's got the right to control the use of the asset? And those three components that I talked about are shown here on the slide. So it has to be an identified asset. We have to have all the economic benefits, substantially all of the economic benefits. We have to have the ability to direct the use of the asset. So I said I get lots and lots of questions on how do I get out of lease accounting and how do I get out of the standard altogether. One of the ways that people keep trying to tell me that they can get out of it is that they do not have an identified asset. And again, I know there's a lot of words on this slide, but I'm going to talk around them. When we're saying, do you have an identified asset, what we're looking at is there an explicit asset or an implicit asset that you are leasing? And in order to determine that, we're saying, does the supplier have a substantive right to substitute? The reason that I'm going into this a little bit more is because I've had a number of emails in the last probably 6 months where my clients have said to me, okay, you talk about this right to substitute. So we've sent an email to the lessor. What does the email say? The email says, can you substitute the asset if you want to? And the lessor writes back and goes, yes, so. So they can substitute. So therefore we fail the definition of the lease. We don't, because that really doesn't tell me anything. What it means by substantive substitution rights is at any point in time, can the lessor come and take that asset and give you a new one or a different one? And is there an economic incentive for them to do that? So there has to be both of those criteria. Now, in most cases, there is no economic incentive for a supplier to come onto your premises because you've given them a card to give them full access 24/7 and take the photocopier and bring you a new photocopier. That's what would be the benefit of that? There isn't one, unless the photocopier is broken and you want a new photocopier. So this substantive substitution rights is actually a fairly high hurdle. It's not an email back from the lessor going, yeah, I guess we probably can substitute if we needed to. If you are in doubt, the answer is there is no substantive substitution right. So it's taking a more prudent approach unless it's really obvious. And some way it could be really obvious is that you are leasing access in a building. It could be a boardroom. There's this one room that's just full of, one building full of boardrooms. You've got access to a boardroom every single day. But you turn up and today they say you're in boardroom 5. Tomorrow they turn up and you're in boardroom 3. Next day you're in a different boardroom. Because they look at who's in there every day and they look at how many people are needed in each boardroom and they substitute. They swap it around based on the relevant economics. That's what we're talking about substantive substitution. So don't get excited and think you can fail because I've seen a few people who've kind of gone, great, we can just get out of that. The next one is right to direct the use of the asset. And people say, well, we can't. We've got an office lease and that office lease says that we can only use it for office services. That's just a protective right of the landlord, just to make sure you don't do anything crazy with their office building and destroy the value of it. If you've rented an office building that the lease says is for office services, quite clearly what you want to do is run office services in there. You can decide which office services that you're running, you can decide what you're doing, but you can't turn it into a circus or a zoo or something crazy like that. But it's all about what are the relevant decisions in relation to use. If it's a vehicle, can you decide what's being carried in that vehicle? Can you decide where that vehicle is being driven? If it's an office building, can you decide which office services are being run? Finding it hard that entities are getting out of that as well. So we have to have those 3 elements. And if we do, regardless of what the piece of paper is called, it is a lease or it contains a lease. It may not be 100% a lease, but there's an embedded lease within that. Any questions on that? What is a lease? From a completeness perspective, my background is external audit. I was an external auditor for a number of years, and we always had completeness drilled into us. I want to know if you've identified all of your leases, don't look in your leases folder. I'm looking at what's not in that leases folder that should be. That's what you guys need to do, because that is what your auditors are going to do. And the last thing you want is during the audit, they identify that there's 10 different agreements that meet the definition of a lease. Bear in mind that your auditors are working across a significant number of clients, and they will find things in one particular entity and go, ah, yeah, that's a lease. Better check for that in every one of my other clients. So you guys need to talk. In your peer groups that you've got, talk about this and actually make sure that you've tried to do that completeness check yourself. Lease payments. Let's take a building for this example. It can be equally applied to a vehicle. And we're leasing a building and we're paying, I don't know, make up a number, $10,000 a month, for example. For that $10,000 a month, we get exclusive use of 3 floors. We get use of the common area, which is the lift, which is the foyer. We get security and concierge services downstairs. We get external cleaning of the windows, and we also get car parking. Which of these meets the definition of a lease? Exclusive use of the 3 floors. Yep. What else?
Is the car park like your spot, or is it an open car park?
So let's say I tell you it's my spot, dedicated 5 spots. It's a lease. What if I tell you all I'm giving you is passes to the car park? No lease. Okay. So car park is, it depends. Depends on the terms and conditions of that car park. What about these 3? What does it depend on?
Depends on whether the cleaning is available.
What do you mean by when the cleaning's available?
External cleaning may not be available all the time.
They clean my windows 3-4 times a year in the contract written.
Service obligation.
Service obligation. It's not an asset in relation to it. I'm buying a service. This, I don't have the right to direct the use of it, and I don't have substantially all of the economic benefits, and these 2 are services. So the top one, most definitely, is a lease component. These 3, most definitely, are not a lease component, and this one, it depends. So I'm paying my $10,000 a month for these multiple components. We know that some of them are leases. Let's assume the car park isn't, and we assume that this one is. So we've got this amount that we pay. AASB 16 applies to leases and lease components. So what AASB 16 says is you need to pull apart that $10,000 a month and work out how much you pay for that, and that's what you recognise in your lease liability. Now, for everybody who is sat here looking horrified at me, and I can see you looking horrified at me, the choice that you have is don't split it. So let's say for the $10,000 a month, we say 6,000 was in relation to that. If we choose to split it, we recognise $6,000 a month as part of our liability. We end up with a lower liability, lower right of use asset, and lower depreciation. If we choose not to separate it, we book the $10,000 as part of our lease liability. Higher lease liability, higher right of use, higher depreciation. But it's much easier not to split. So that's the decision you guys have to make. It is a completely free accounting policy choice for you. But whatever choice you make, you are locked in for that underlying class of assets. So if you do it for one building, you do it for every building. Take something like a vehicle. Could be things like servicing costs, maintenance, petrol, roadside assistance that you're paying for within that one lump sum. Yeah.
So you still get that choice of not splitting if the lease component is like a lower percentage, like your example was a majority.
Yeah, absolutely.
You still get that choice.
They'll get free choice. Yeah, and it might be the case, you know, it's in mine. I work with a lot of local councils and their waste management services. There's often a lease in place of the rubbish trucks, but the rubbish truck component is really small compared to the rest of it. So absolutely free choice. The only condition is once you've made a decision for that class of asset, that's in. You're in for that class of asset. Yeah. Yep, you always still have the choice. I would say if your lease specified it, split. Because there's no discretion, there's nothing you've got to think about. What we do find, however, is it often splits it. So it might have all of this and then have a separate amount for the car park, or it might have the outgoings that are separate, but you've got to still think, I've got these other components within there. So if you choose to split it, where do you find the numbers? It's not in the lease. You can ask the lessor. Will they tell you? Probably not. The reason they probably won't tell you is because there's often a profit margin. So if you're told that they will charge you whatever they charge you for cleaning, and you go, well, actually, I can get Mr. Window Cleaner in, and he'll clean it for half the price. I don't want your cleaning. That's why they don't tell you. They've got the information. They have to split it. Property Council of Australia, and I still haven't checked. Every time I say this, I think I must check, and I don't, because I forget the minute I walk out the room. Property Council of Australia apparently has published something that says for leases, it might be that, and I'm making up the numbers, 5% is in relation to security, 10% is in relation to concierge. So apparently there is some kind of finger in the air type thing that you can use as a basis, but that you're going to have judgment about splitting it, but it also will give you much lower liabilities than assets. So you've got to think about where your sensitivity is around that. Any more questions or comments on that one? Interest rate is causing huge issues. What the standard says is use the rate that is implicit in the lease, and that's fantastic, except there's no interest rates implicit in leases. There is in finance leases, but we still are not seeing them in relation to what were all operating leases. So my first thing I would tell you to do is go back to the lessor and ask them. Will they tell you? Possibly, possibly not. Depends on the lessor. They've got that information because they have to have that information. So they may tell you, and in which case that's easy, great. If you can't get it, the standard then tells you that you use the incremental borrowing rate. The reason for saying that is because you're leasing something, it's a financing arrangement. If you weren't leasing it, let's assume you bought it. Buy it, you haven't got the cash, you've got the bank and ask them to lend you the money. What rate would they lend you that money at for a similar asset over a similar term using your credit risk, using the current economic environment? There's only one way that you can get that number 100% accurately, and that's playing a game of let's pretend with the bank. The bank are getting very sick of let's pretend, and are generally not saying anything more. Because they don't want every one of their customers, every time they sign a lease, ringing up going, so let's pretend we're going to get a loan, what would you lend it at? Because quite clearly you're not doing it for this purpose. So how do we actually get this number? I can't give you the easy answer. There isn't an easy answer. If you've got existing borrowings on a floating interest rate on a secured asset, great place to start. If you've got a bank overdraft, that's generally not secured. So somewhere to start, but you're going to have to adjust it. It is not the risk-free rate. It is not any fixed borrowing rate. The RBA publish indicative lending rates. Again, not a great place to start, but you've got to look at your risk margin. If you can get the bank to give you an indicative lending rate at a certain date, fantastic. Compare that to the RBA indicative lending rate, and it will give you some awareness of what your risk margin is. And then every time you take out a new lease, do exactly that same process. You go to the RBA rate and add on whatever that risk margin is. Is it 100% accurate? No. But is it a methodology? Absolutely. Auditors are going to be pragmatic around this because there is no way of coming up with a number. It's got to be based on what is a reasonable circumstance. I've seen a number of listed financial statements. Some of them are from overseas, where the interest rate is extremely low. So I'm caveating my response with that. The ones I've seen have varied from an incremental borrowing rate of 2% up to 14%. And that is for a listed entity. That is a huge range. So I can tell you to look at the listed and see what's out there, but depending on which one you pick, you're going to get a very different number. So think about your methodology, come up with what is appropriate, run it past your auditors, and just stick with that methodology. Different people have different motivations, probably less so in the not-for-profit space, but the higher your interest rate is, the lower your liability is, but the higher your interest expense is. The lower that your interest rate is, the higher your liability is, but the lower your interest rate is. So if you've got different covenants, you may have different incentives to do something differently. So this is causing huge concerns. And as I say, we can't give you a definitive answer because it's very much an entity specific. Any questions on that? Yep.
Would you be able to consider materiality as to whether you can apply for or not? Let's say you're only talking about 2 printers.
Yep. So if all you've got are 2 printers, I would be saying, can you use the lease as a low value assets? So the range around that is somewhere around $8,000 to $10,000 that we're seeing in Australia. But remember, it's the value of the asset, yeah, value of the printer. So if the value of your printer is less than that, use the low value exception. If not, if it's above that, materiality always exists. But what you're looking at is if you signed a 5-year lease and you're paying a substantial sum of money, it might actually be a material number. The only way you can say it's not material is if you calculated it. And it's material, remember, for the asset, the liability, interest and depreciation. One of those is often material. Yeah. But materiality does always exist.
You got idea storage space.
Yep.
And you sublet it.
Yep. I might park your question because I'm going to talk about subleases. It's not a nice answer, so it's near the end, so nobody throws things at me. So let's move on to lease term. So our lease term is our non-cancelable period of the lease. And then if we have extension periods, and it's entirely up to our discretion, we take into account those extension periods if we are reasonably certain to extend it. That's where the discretion is ours. Now, there's been huge confusion around lease terms, and particularly where we have things like month-to-month. So what the standard says is it depends who's got the ability to enforce, who's got the ability to cancel. So where both the lessee and the lessor each have the right to cancel it without permission from anybody else, the lease is no longer enforceable if neither party would incur more than an insignificant penalty. Now park that in your head because I'm going to come back to that. If it's only the lessee that has the right to terminate, and that's generally what we see happening on an optional period, so the lessee gets to decide whether they want to renew that option, that's where we take into account the reasonably certain date. If it's only the lessor who has the right to terminate, as the lessee, we ignore that. So we signed a 10-year lease, but the lessor has the right to cancel after 7 years. We don't know what the lessor is going to do, so we assume the lease term is 10. I'm going to come back to the first one. So the first one, everyone got really excited about. Well, great, we'll just go month to month, because then everything's only short term, because we can all cancel without permission within a month. And that was pushed up to the International Interpretations Committee. They recently put out their agenda decision. An agenda decision is, again, not necessarily enforceable because it's not in a pronouncement, but you'd be very brave to go against an agenda decision that's being put out by the International Interpretations Committee. What they were asked is, okay, on a month to month, can we just say it's not enforceable beyond that period? What do you mean by no party incurs more than an insignificant penalty? Because there's no termination. So everybody's just saying, well, there isn't one. And what they said was, we need you to consider the broader economics of the contract. If you are in a specialized building or you are leasing a specialized asset, how hard is it for you to find another building that's fit out for the way you want it? How hard would it be for the lessor to find another tenant that would want this building that is set out the way that you've got it? How much cost would they have to incur? If either party would incur significant costs to find an alternative asset, it is deemed to be more than an insignificant penalty. So unless you've got something like a plain vanilla corporate office that you can jump up and move anywhere within Sydney, it is deemed that you are probably going to have one party will have more than an insignificant penalty. I'm not going to read these words, but what effectively it says is, in that case, you would go beyond the month. You could possibly go beyond the legal term of the contract if you've got options within that. So you are estimating what that lease term is. Now that's horrific, because how far out do we go in relation to that? So it's coming up with a number that's not ridiculously far out, but is not too short, because if we're planning on staying there, and particularly in many cases, you might have a below market value rent, you're going to incur significant costs if you move anywhere else where you may not get that. So lease term is also something that's going to be a challenge. Let's have a look at the short-term lease exception. And I said that this was in place for leases with a lease term of 12 months or less. One of the issues that we've got, however, is in this example, I've signed a lease on the 1st of January, or it kicks in on the 1st of January and expires on the 31st of December. And I thought I was only going to need this particular asset for 12 months. So I applied the short-term lease exception. Something happened which meant I actually needed it for longer. And on the 30th of September, I signed a new 12-month lease that commenced on the 1st of January X2. So effectively the second after the old one went in or expired. So I've now got two short-term leases, two 12-month leases. Can I continue to apply the short-term exception? And think about your system and how you track this. Because if you put it in your system and say it starts here and it finishes here, your system may well go, yeah, fantastic, another 12-month lease. What the standard requires you to do, however, is to reconsider at the modification date. At the modification date, what's my remaining lease term? 15 months. That's more than 12 months, which means it does not meet the definition to continue using it as a short-term exception. So whenever we change something, we have to be considering what have we actually got and making sure that we're not just looking at the legal form of the lease. This, as we start getting more and more into this leasing standard, things like these changes are going to cause huge issues because we just haven't thought about them necessarily in relation to this. So anytime you've got a change and you're using the short-term lease exception, please make sure that you are still considering it at the modification date. What is my remaining term?
What if you signed a lease on storage and the lease is expired and you're on a monthly term?
Yeah. So if you haven't moved out and you've got no intention to move out and you would incur those significant costs, it comes back to that enforceability. So you've got to go out and estimate that lease term longer than month to month. I want to look at variable lease payments. So this is CPI. It's very common that our leases have got CPI increases within them. And what we do with those is we can't estimate what CPI is. So if I'm paying 100 today and I'm required to increase that payment by CPI next year, I assume that my payments will remain 100 for the life of the lease. And I calculate my lease liability on that way. Next year, when CPI increases and my payments have gone up to 103, I recalculate the lease liability, assuming 103, the remaining life of the lease. Following year, when it goes up to 107, I recalculate again, assuming it will be 107 for the life of the lease. This is not a set and forget standard. Every time CPI changes, you are recalculating. Now, when you've got more than one lease and your lease anniversary dates are not the same, potentially this could be happening every month. How again are you tracking this? The next type of variable payments are due to sales or usage. So let's take a photocopier and I pay 10 cents a copy. I don't know how many copies I'm going to make. I can't guess how many copies I'm going to make. So every time you use the photocopier, I know you're not going to do this, but bear with me. You would put through your 10 cents to the general ledger. So that gets recognized through the expense as and when incurred. Anything that relates to sales or usage. The third type of payment is just what the International Board put in to stop structuring of leases. So if I wrote a lease that said you only need to pay me if the asset that you give me works, that sounds like it's variable. Realistically, if I give you an asset that's broken, you're just going to ask for a new asset. So there's no way of avoiding that payment. So what they've called that is in substance fixed lease payments. Don't make it look like it's variable when it's really not. Conscious of the time, so I've got some scenarios on here. I'm going to tell you the answers to them rather than get you guys to tell me the answers. We've got a photocopier lease. We only pay 10 cents per copy and there is no minimum payment. If that is the scenario, the lease liability is nil because we cannot estimate that. There is no floor, there is no fixed amount. Different if I said you need to pay me at least $200 every month, then I would recognize that. Completely variable, you still have a lease. You are still within the scope of AASB 16. You are still doing lease accounting. It's just that your liability is nil. In this one, we've got that $100,000 that we pay in year one, we assume that we will pay $100,000 for the remainder of the lease. CPI has gone up, payments have increased to 104. We assume that we recalculate, assuming our payments will be 104 for the life of the lease. So we change it, but we don't estimate. We base it on what we are currently paying. Any questions or comments on that one?
What the lease agreement says it increases by 3, does it say CPI? It says 3%.
Fixed 3%, you would factor that in because that's known. Same as if it was greater than 3%, greater of 3% CPI, you would still factor in the 3% and then adjust. Do you have a question? Is that your question? Okay. Correct. The right of use is the balancing figure. So you recalculate the lease liability, and then once that's right, you will, let's say it's increased by 3,000, you would credit lease liability 3,000, debit right of use 3,000, and then adjust your depreciation. Yeah. Subleases. Within this standard, we have two models. We have a model for lessors, which is a requirement to still classify between operating and finance leases. And we have requirement for lessees, which is the right of use asset. If you've got a sublease situation, you're fine if you're the head lessor because you're in the lessor model. You're fine if you're in the sublessee because you're in the lessee model. If you're here, you're not fine because you're in both models. So what you are required to do is to recognise your right of use as part of the head lease. And then when you sign the sublease, you're required to classify that lease into a finance or an operating lease. The way that we're seeing subleases generally work is you sublease for the remaining term. And because you're subleasing the asset that you are entitled to for its remaining life to you, in most cases it's a finance lease. If it's a finance lease, you are required to de-recognise the right of use asset or the portion of the right of use asset if you're only subleasing a portion of it. You recognise a net investment in a finance lease receivable, which are not necessarily the same because the interest rate could change, you are incurring different costs. You still retain your lease liability and you still retain a make good provision. If it's an operating lease, it's easy because you still just keep your right of use and recognise that income as you can. So the reason it's so messy is because you're in both of these models. You've got this right of use that you need to deal with, and in many cases, de-recognise it and determine the finance lease. You're in that sublease situation. Are you subleasing for the remaining term?
Subleasing, yeah, for the remaining.
Yeah, so it would be a finance lease. So you're recognising your right of use under the head lease, and then you're de-recognising it and you're having to go through the calculation of it. Obviously, materiality always exists. If you're only subleasing a tiny portion, I don't know. Most of it good. Yeah. So just make sure you're looking at that because the calculation is actually really quite messy. Yeah. The next issue is in relation to lease incentives. This is another really messy issue. And the problem is, because everyone ignores these accounting standards until kind of almost the last day, people didn't realise that when you start working through incentives within the standard, there's actually a huge lack of guidance. We used to have an interpretation, and that interpretation dealt with lease incentives for operating leases. That interpretation was withdrawn and the guidance wasn't transferred. So we see within the standard, it talks about lease incentives in the right of use asset. This is less any lease incentives received, and in the liability, less any lease incentives receivable. One of the issues is what's a lease incentive, because the definition under the standard refers to where the lessor pays the lessee. So let's take something like a rent-free period. Arguably, the lessor are not paying the lessee, and therefore a rent-free period technically fails the definition of the lease incentive. Now, in my view, I can be quite simple sometimes. Well, let's make things easier. If you've got a rent-free period, you're just paying less rent. Therefore, your lease liability is lower. Let's not get caught up in how we deal with this and whether it is or is not a lease incentive. The issue that's arisen is mainly around fit-outs, particularly where if you are putting through a fit-out and you're paying for it and then the lessor reimburses you for that fit-out, is that an incentive or not? Because you're improving the lessor's building. So are you getting the benefit or is the lessor getting the benefit? Well, it depends. Depends how long the lease is and depends if you're running the full useful life down and if you have to remove it at the end. So whilst I can't give you an answer to this because the international board said, probably an issue. But the standard's in place now, can't really do anything at this point in time. So there's an illustrative example, and there was a sentence in that which was causing particular issues because it was just conflicting. So what they said is, what we'll do is we'll remove that sentence. Doesn't help because there still is no guidance. So if you do have these lease incentives, I would encourage you to have a chat with your advisors and come up with a policy. There's been some great comment letters that have been put into the international board. CPA put a good one in which actually sets out the scenarios that existed. Pick a policy, stick with it until the international board decides to put some guidance out on this, and that will be part of the post-implementation review on this. They will not do anything before that. So we're at least 3 to 5 years away from having any guidance. The differing views are around, if this is receivable and this is received, let's say we got some cash 3 months into the lease, it's receivable here, it then becomes received, then we really have to be adjusting it. And if we get a payment fee fit out, a year into the lease, again, then we have to kind of make those amendments, and how much adjusting do we have to do. So just be aware that lease incentives are an issue, and have a chat to your advisor if they're not something as simple as a rent-free period. In relation to peppercorns, nothing has changed from last time I spoke to you. There is still that temporary option to be able to hold them at cost, so still don't recognise them. And ED is going to come out that deals with fair value and also deals with fair value on restricted assets. So that will have some information in there about how we deal with right of use assets arising from a peppercorn. We are discussing it at the March meeting. I don't know where it currently is sitting. I know that there was a fair value advisory panel earlier this week that I couldn't make, but I don't know where that's got to. So just a bit of a watch this space, but at this point in time, nothing has changed with peppercorns, except you still need to include some disclosures around them, which has never been included before this. So tell us about the nature, the extent of the peppercorn or concessionary leases that you've got. So you still need to identify those. From a transition perspective, similar to what we saw with revenue, you have a choice. I would be very strongly recommending that you do this, that you do not restate comparatives in relation to your leases. And you've then got a choice in how you deal with your right of use asset. Do you make the right of use equal to your lease liability, which means all you have to calculate is one component? That's the easiest way, and that's what we're seeing most people do. Or do you go back from day one and calculate your right of use properly? Again, I would go the easy option and do this. You can't do it going forward, but you can do it on transition for all leases in place at that date. From a transition perspective, assuming that you do that red side, you only have one transition disclosure. And that is a transition disclosure that requires you to compare your operating lease commitment note at the day before you adopted this standard to the lease liability the day after you adopted this standard. So that's a reconciliation that is needed. Things like you've applied a different discount rate under the lease liability standard under 16. You've added back operating leases, etc. You've taken out short-term leases, you've taken out leases of low-value assets. We'll look at an example of that. In relation to transition practical expedience, I've referred to a few of these as we've been going around. These are all expedients to make your life easier on transition. Again, my very strong recommendation is to look at them and adopt them. Do not start your detailed work on AASB 16 unless you know which of these you're going to adopt, because you could actually be creating a lot more work for yourself when you realise that there is something you could have used here. We have talked about these in huge amounts of detail before. I just wanted to put them up as another reminder. We are seeing some real life disclosures, and these were more in here just to kind of illustrate to you the volume of what we're seeing. These are listed because nobody else has early adopted this standard. And some of the things I've highlighted is around they have used modified retrospective. They've chosen to exclude leases of low value assets and short-term leases. We've had to use the incremental borrowing rate because we can't get the implicit rate. Some of the figures, so we've got assets increasing by 130 million euros, liabilities by significant numbers, tells us the discount rate. They then tell us in the half year and how we've got that difference in the P&L. Because remember, in the P&L, we don't have operating lease expense. What we have is interest and depreciation. This one, the reason I quite like this one is because I love the fact that they say that they've chosen to make some decisions and adopted expedients to reduce the complexity of its implementation. This is that reconciliation that I've just been talking about. So where we have to reconcile the operating lease commitment note to the lease liability. It just gives you a real life example of what that looks like. To finish off, similar to what I did with revenue, I just want you to think about your processes. What are you actually doing about this? Who's tracking new arrangements? Who's making sure whether they're leases or not? Who can sign these agreements? Think about your delegations. Think about the key terms and conditions. For any existing leases, what if they change? Who's doing that? When are they doing that? Have we actually got a process in place to think about that? There's lots happening in this space. Now, I know that I keep saying I've talked about revenue and leases for, I don't know, the last 4 years of these sessions, but every time we come, there's new issues that we've identified. So think about this, as I've said already, please give the time and effort and love to these standards, don't underestimate it. Have you thought about your systems? Excel will not cut it to run your revenue system. I've got so many entities who say to me, well, we're running SB 15 through Excel. You can't, it will not work. It might work for year one because you haven't been prepared enough at the beginning of the period. It cannot work going forward. You have to get your accounting system to run based on the accounting standards you've got to do. From a leasing perspective, it may work, Excel, for if you've got less than about 5 leases. Anything more than that, we have to be thinking about how we're going to manage this. And Excel won't tell you if you've changed a particular component in the lease, or do you have to change the discount rate or not? If you put in that short-term lease example, actually it's now a 15-month lease, it's not a 12-month lease, so you have to do something different with that. So we need to think about how we're going to track this. Think about your budgets, your management accounts. Have you updated them? Because many of you are probably in a position to be doing your budgets for next year. Do they reflect SB 15, 1058 and 16? And if they don't, you've got another year of your statutory accounts being different from your budget. And ask for help if you need it. These standards aren't easy. So don't think that you've got to sit and work through them on your own. You've got a number of people in the room. There's been a fair bit of networking happening. Talk to people. Think about it. Ask your advisors. But don't think you need to struggle through this on your own.